Hello and welcome everyone to the Manulife Investment Management Asset Class Outlook webinar series. Just a quick couple of housekeeping points before we kick off today. For those of you who dial in, we appreciate you stay on mute throughout the whole session. Most of you who join via the webinar platform, please do submit questions during the webinar. You can do so by submitting questions below the screen. We will endeavor to address as many questions as we can today. As we are entering the second quarter, markets are now keen to search for a new narrative instead of just searching for yields. Our speaker today, Luke Brown, Head of Asset Allocation Asia, will give us that narrative from Asset Allocation team's perspective. Luke will give us the macro outlook for the second quarter, the overall asset allocation view, and some granular asset classes that his team find attractive. And towards the end, Luke will answer any questions you may have. Over to you now, Luke.
Thank you, and thank you all for joining me this afternoon. The objective of today is to give you our observations over the evolving market conditions, the macro landscape, and how we're approaching our asset allocation and portfolio construction considerations in this environment of heightened risk and uncertainty. So, I think clear to all is that the price action in risk assets is outright evidence of the impact of coronavirus and the other macro factors that we presently see. We need to understand that something like 90% of the global economy has been impacted, albeit to different degrees, but a significant growth shock is roundly predicted. Just by way of example, there are many estimates now that indicate that Q2 US growth could contract between 10 and 30% on an annualized basis. And to me, this range of outcomes captures the very uncertainty that we face. However, I think what we also need to recognize is that we have seen concerted and increasingly coordinated efforts from central banks and governments, and we're seeing aggressive deployment of both monetary and fiscal tools with a view to avoiding a deep and prolonged recessionary phase. Just as a soundbite on the sheer scale that we're seeing in fiscal stimulus, just in the US alone, we're seeing that this stimulus is estimated to be something like 9% of US GDP. Now, whilst we have seen this aggressive repricing and I think a broad-based liquidation of risk assets, the graph that we have in front of you illustrates that we do need to balance this context with the data. Okay, just looking at US equities, and this is the green line on top, we can see that the levels that we presently see were last seen in 2018. Now, no doubt this is a material retracement, but I do believe that in the context of long-term investing, it's one that we need to navigate rather than panic about. So, what have been the catalysts for these corrections we're seeing in markets? So we know that at present coronavirus is probably the dominating factor in headlines, but we can also look to some other points. And what we observe and what we understand as seasoned investors is that markets react to fear and uncertainty. Here we're looking at the VIX index as a measure of market fear. And if I just look back to a little over a year ago, so this is January 19, and you can see the first point, we observed that jitters were starting to emerge in markets because the Fed was giving guidance over potential tightening of monetary policy. Now, if we roll forwards to late 2019, we had a series of emerging risks coming into the market, which precipitated this rise in the VIX index and ultimately a fear gauge. And these range from trade wars, the coronavirus outbreak in Wuhan, forward indicators arguably under-assessing the potential for the global impact. And then, of course, we get to the point where coronavirus is declared a global pandemic, and it's clear to all to see the impact of this. Now, with all of this going on, and I talked about the headline figures, I think also the battle that we're currently seeing to control oil markets is also something that we need to be very cognizant of, and the impact that it will have on potential for global growth and ultimate recovery. Now, at this point, I suspect that many of you are wondering if we can actually see any good news on the horizon at all. Now, what I do want us to look at and try and learn from is history. So over the past quarter of a century, there have been numerous dramatic drawdowns, particularly in equity markets. And here we are looking at the contractions and subsequent recoveries on US equities. Now, what we observe is that the recovery can be as equally sharp once the symptoms are understood and addressed. Now, what this tells me as a long-term investor is that this gives us an opportunity to secure material medium-term upside. Okay, and that's something that I think we should all be taking into account. There's more that we need to think about. Timing the market is with any kind of precision, I think is seldom achievable, or at least is an aspirational goal. But time in the market is something that we can do through considered holding periods. And I've just done a simple analysis here just to demonstrate the thought process around here. And what you can see is the green line, which is very jagged and volatile. This is the volatility of a 1-year holding period return. The blue line, much smoother, but still has episodes of peaks and troughs. That's a 5-year holding period return. And then the final line offers the volatility in returns experienced for 10-year holding. And the simple message to take from this is that by holding on to your allocations, by staying invested in the market through these episodes of volatility and risk, you can get a smoother and more predictable outcome. So, having understood some of the catalysts and the immediate impact that we see in markets, what we do need to be doing in our longer-term portfolio construction is navigating these periods of uncertainty, but remaining anchored in our long-term investment goals. So to do this, part of our process is to assess the outlook for our investments, and we do this by looking across a medium-term outlook across a broad array of asset classes and also within asset classes. Now, we believe that a robust review of these returns is critical in understanding portfolio positioning, not just actions we take today, but also the actions that we will take through time to best navigate and try and achieve the investment objectives for our clients. Just looking at these charts, what I hope you can take away is that there remain, through the medium term, interesting and attractive investment opportunities, and we can tap into those. Now, just a quick note from me, because I realize there's a lot of data here. There are certain things that I would tease out of it, and we will come on to this later in the presentation, but just looking at these returns, I think, at the moment we would have biases across credit, emerging markets, and Asia. Developed markets, they do offer returns that we can access, but they are just less attractive to us on a relative basis. And what are the macro environments? So I've highlighted here the main themes that we see impacting the return path of asset classes on the near term. Now, if I boil these down to an attempt at a more simple message, it shouldn't come as a surprise to anybody that we see a number of factors that are likely to weigh on market returns in the near term. And the present macro landscape is a pretty clear picture, one of heightened risk, heightened uncertainty, negative shock to the decade of growth that we have enjoyed. But we do have to have balance in our outlook. So what we do, having understood the macro environment, is we populate our thoughts and our research around a set of macro assumptions. And here what we have done is we have taken those macro assumptions and we have separated into those that we think pose immediate positives for global markets and those that pose immediate concerns for global markets. Now, clearly, the environment is challenged, but we are seeing a number of emerging factors that could potentially turn the tide. The particular focus, I think, for all should be on the actions of governments and central banks. This is stimulus and it is liquidity. But if I was to say one factor to watch, at least for now, it's going to be the evolution of the credit markets, and this offers both risk and reward. A couple of things that we could tease out from this. I'm sure that people are familiar with the pricing dislocation that we have recently seen in certain very large investment-grade ETFs, and this was driven primarily by the lack of liquidity that we were seeing. These anomalies have broadly reversed, and as I say, this has been a function of the influence of central banks, in particular the Fed stepping in. So we are seeing that action is being taken, and that action can have positive outcomes for us. Now, having noted the balance in our outlook, I do want to touch just briefly on the specifics that we are seeing from certain governments and central banks. And in this slide here, this is the detail of the US fiscal and monetary stimulus, and there's a number that I want people to focus on. That's $2.2 trillion of fiscal stimulus. Let me say that again, $2.2 trillion. Now, fiscal impetus of this scale, whilst it's not unheard of, is certainly out of the ordinary. And I would suggest that there's probably more to come. The more fiscal stimulus we see, and this is moving beyond traditional monetary policy as a complement to it, I think the greater potential for recovery that we could ultimately see in markets. We do need to understand that fiscal stimulus does take time to bleed through. However, the sheer scale of this is clearly material and is likely to have positive impact ultimately. So our focus within the team and in all the discussions we have is to attempt to digest all of the information that we have available, to review markets and determine where we should be allocating our clients' capital, cognizant of the investment objectives that we are attempting to meet. Now, we decompose those market views into both strategic and tactical. So the tactical side, which is on the left-hand side of this chart, you can see this is the shorter term, let's say out to 1 year. And then the longer term, more strategic view, this is out to 5 months. So I've included a selection of potential allocations. Our process covers, as I say, a broad array of markets. But I just wanted to tease out from those investment horizons some of the specifics that we might look to. Now, clearly, we need to put this in the context of portfolio construction and also in terms of risk budgeting. However, I do believe that there is a common theme coming out of our research, and broadly speaking, that would be that we are constructive on select Asian asset classes. We do like credit, particularly on the longer term, and combining these with selective positioning into US and EM equities is where we would like to steer our portfolios. We think these give the greatest opportunity of return through the investment horizons we're looking at here. Now, within this, and just briefly, because I get a lot of questions around high yield and Asian credit and comparables. So I just wanted to drill a little bit more deeply into this. Now, as you can see from the two charts here, high yield spreads, which is on the left-hand side, they have certainly widened, but in no circumstances have we reached the 2008 crisis levels. Now, I'm not suggesting that they will widen to that level. If anything, I do believe that high yield potentially offers another interesting investment opportunity, not least given these elevated spreads that we are seeing. However, we do need to consider all aspects of potential positioning, and I think, as I mentioned earlier, looking at the challenges that are being faced in the energy sector and the glut of oil and suppressed prices, for me, avoiding specific exposure to the energy sector might prove wise for people taking a high yield allocation. Now, there are going to be further bumps in the road. There is going to be ongoing volatility, and we're waiting to see what the market tells us over the path that it could potentially take over the shorter term. And we might see greater spread widening in high yield. But if we then tilt towards the longer term allocations, that volatility could well be acceptable as the trade-off for the potential returns we can generate. And then to Asian credit, and this is the chart on the right-hand side, and it tells something of a different story. Now, this is yield on broad-based Asia credit, and I would say that they've been relatively well-behaved compared to other markets and sectors as we've gone through this volatile and evolving period in time. Now, this is in part due to, I think, the strong fundamentals that we see, but also perhaps influenced by an existing valuation cushion within those specific markets. And I just want to give a quick nod to U.S. equity markets. Now, notwithstanding the demand shock that's inevitable from coronavirus impacts and the sort of self-isolation that we're seeing at the moment, if I just look to the implied PE ratios, I think this offers us some valuable intelligence. Now, on this metric, and clearly it's only one metric or one lens to look through, US equities would have the potential to offer growth with a reversion to the longer-term average for PAs that we have seen over the observation period you have here, which is the last decade. Now, I do caution that data flow is going to be a key determinant in the eventual path of US equities. So we may well continue to see outsized day-to-day moves until we start to see more reliable trends form and we find a new normal in markets. So, to summarize, the way I would encapture the global macro outlook is that while risk clearly remains elevated and there is clearly uncertainty in the market and it's likely to dominate in the short term with the headline risk, we are seeing opportunity. Investment horizon of risk appetite and risk tolerance are going to be the key considerations in determining what the right allocations are for portfolios. And armed with that, hopefully this has given you some insights into our approach. I would be delighted to take questions if there are any.
Thank you, Luke. Thank you for your very engaging presentation. I see there are a number of questions coming up here, so I will do it one by one with you. So the first one here is interested to know, what do you think will be the shape of the economic recovery? Would it be a V, U, L, or W shape, or more like a swoosh? What do you think?
That's a great question, and it's the first time I've heard the swoosh be referenced on one of these. So this is the Nike swoosh, so an aggressive decline and then a more gradual recovery. So look, the answer I can give you is that it's very difficult to be specific. If I look at all the research out there, I think, if we were to be in a situation where the impact of coronavirus waned very quickly and probably, within the next 6 to 8 weeks, then I think with the liquidity taps on, with aggressive monetary policy, with the fiscal stimulus we have, you would be more inclined to a V-shaped recession or recovery. If, however, coronavirus and the impact on production lines and the lack of employment and furloughing of a huge segment of employment across the globe, if that extends into June, then you're more in the U-shaped territory. But I think with both of those, my point would be there is the potential for this aggressive recovery. Now, an L shape, again, this is, for me, is going to be if the impact that we see on global supply chains and getting everything back on board and critically consumer demand, this is the L-shaped type recovery where we can see things stretching probably out further into 2021. And then the swoosh, I think, is a nice way of thinking about it. It's probably the medium ground that I would take, because what that's suggesting is that, we are seeing an aggressive decline. I don't think anybody can dispute that, but probably we are going to see a more gradual move back to sort of normal growth in markets where we have different parts of the world coming back in sort of online at different points. Our expectations are that Asia is closer to that than the rest of the world. But unfortunately, we just need to watch what happens in particular with those coronavirus headlines.
Our next question here is, where does the U.S. government get the $2.2 trillion to support the fiscal stimulus that you just mentioned? I think the question is obviously interested to know, how can the U.S. government finance this fiscal stimulus?
Yeah, and look, this is another great question. So I think, what we're getting into here is the realms of MMT, modern monetary theory. And, effectively, I would say for governments that are issuing or are creating cash in their own currency, they can simply print more. Now, the difficulty with all of this, and I suppose what's at the heart of the question, is not just whether or not you can raise 2.2 trillion of investment. Theoretically, that is doable, but at what point does it get replayed? And I think what we have to look at is the fact that rather than just being outright spending, this is deliberately designed to be investment. This is fiscal spending. So this is investment in infrastructure. It is investment in various parts of the economies that have a tangible value. Hopefully that answers the question.
Our next question here is interested to know from a geographical distribution in terms of US, Asia, Europe, and EM markets. Where do you see, or where would you prefer to see more opportunities?
The way we are positioned at the moment, I think there is more opportunity in Asian markets. And the reason for that is that we believe, as I mentioned on one of the previous questions, that Asia is closer to the end of this journey than the beginning. Now, what would change or influence my view on that would be if we were to see greater secondary infections, if we were to see the lack of, I suppose, return to normalcy. Now, within that, of course, and we do need to consider allocations not just regionally but also across asset classes and within asset classes. So the data that we provided, of course, was at quite a high level, but I think we need to selectively look under specific asset classes. So, for example, taking exposure to growth-orientated stocks, which have been a key driver, certainly in US markets over the past many sessions. So it is going to be a case, I think, of tilting towards Asia. US has the opportunity to recover aggressively depending on when they emerge from the shutdown through coronavirus. The EU has had structural problems for quite some time, notwithstanding Brexit. So I think, for me, just Europe, there are more known unknowns than perhaps elsewhere in the world.
There is a question here interested to know your shorter-term view towards U.S. high yield and Asia credit. Can you give us some insight on that?
Yeah, absolutely. So, and I sort of touched on this in a couple of sections. I think, U.S. high yield, as we know that there is a reasonable amount of exposure to the energy sector, and in particular shale. Now, the challenge there, of course, is that we have seen a lot of action from OPEC Plus, Russia, and it's unclear what the evolution is going to be. Oil is at a very suppressed level. This is a long-term game of attrition, and at the moment, it doesn't look like any of the involved parties are blinking. So, I would have concerns over specific exposures into energy. Now, those equally, they could dissipate if we get a recovery in oil or there is action from the Federal Reserve or the U.S. government to support those industries, which, is not a zero probability. If I turn my mind to Asia, I do think that, there are those economies and credits that can benefit from the recovery. And as the global economy returns to a more normal path, but clearly this is very timeline influence. I do think what I was trying to illustrate in the chart on Asian credits is that they have been more behaved. And I think that that's because, fundamentally there is strength, that many of the credits that we have seen in Asia are already benefiting from something of a valuation cushion. So that means that they have been less prone to the volatile spikes that we have seen elsewhere. And I still think from, certainly the medium term, and let's say beyond the end of 2020, that the investment opportunities are attractive, but obviously in a considered manner, in a diversified and well-constructed portfolio. Okay.
There is another question here. Do you see higher chance of default risk in the EM debt, given that some EM countries are oil-producing countries and flight to safety among global investors? And any reason why our asset allocation team is constructive on EM debt?
Yeah, look, it's a good question, and clearly, when you're looking at high-level allocations, and again, I mentioned this previously, once you start drilling down into it, you need to be selective about where you want to take those exposures. And EM debt is clearly a broad brush look across the market. Yes, there is the potential for certain of those issuers to be more impacted than others. Equally, I would argue that oil pressure could be a benefit for those that are net importers and will benefit from a lower oil price. So it is challenging, and you must be selective. If anything, and perhaps this is a topic of conversation for another presentation, I would go so far as to argue that looking forwards and looking at the volatility we see in markets, this is why active management, I think, can be hugely beneficial, particularly in times like this, avoiding risks as well as taking opportunities.
You mentioned earlier that there is some deflationary pressures in your presentation. So there is a question here. So what chance is there that inflation will become an issue due to factors such as the huge stimulus, shale oil producers closing down, supply chains become more localized?
Yeah, so it's a very interesting question, actually, because yes, and we highlight this in our macro landscape, emerging deflationary pressures. It's interesting the way the question is framed, that, is there the potential that inflation will become an issue? I would argue that inflation is something that central banks around the globe have been targeting and trying to introduce. And their efforts have been somewhat stymied by clearly evolution of the markets. So it is something that we're watching, and we are looking at forward inflation measures, for example. And my view on this would be that a controlled burst, even of heightened inflation, is something that would be hugely beneficial for the global economy. And if you think about it, in some ways, it potentially answers, one of the earlier questions over, how are governments going to repay their debt, inflate their way out of it. And again, just referencing other comments I've made, if you look at the sort of theory behind MMT, the desire here is that it can be inflationary, but it can be controlled inflation, because once that starts bleeding into the economy, other actions can be taken in terms of taxation, or in terms of, removing certain elements of cash flows in the economy to control inflation if it gets to a level that is unsustainable or undesirable.
Right. We do see some questions coming up. Maybe we can have time for the last two questions here. So this is a question about related to a previous question. How will the US dollar 2.2 trillion stimulus package affect the US dollar strength and the strength of some EM currencies?
Yeah, and again, this is something that we wrestle with on a regular basis. So US dollar strength is particular, and it is there at the moment, and we have seen the price action, and US dollar has been strong for quite some time. The central view here is, I think, that the dollar will remain strong in the short term, and this is based on the fact that there is a global shortage of US dollars. Now, clearly action has been taken by the Fed in particular, putting lines in place across a number of dollar consumers and central banks, etc. But for the shorter term, I think the dollar will remain strong. Longer term, I think, as the impact of the stimulus goes through, if liquidity continues to be prevalent in markets, we get over dollar shortages, I think that's the point that you should be looking for a weakening of the US dollar.
Our last question here is related to the team's ability to navigate across and within asset classes. So what do you think will be the time that distressed debt can be a place to invest?
Tricky question to answer, and I'm just being honest. So look, distressed debt isn't something that I particularly look at. I think to answer that question, we have a very well-resourced fixed income team, and I think that they would be better placed than me to give you specifics around that.
Okay. Thank you. Thank you, Luke, for your presentation and your time in interacting with our audience. We are going to end here. Our sales team will follow up with you for those unanswered questions. We appreciate everybody's time, and thank you once again. Goodbye.